PhillipCapital Experts Talk. My name is Lindsay from Phillip Securities Research. Today, we are privileged to have Mr. Bharat Joshi, Investment Manager from Aberdeen Asset Management, to share with us his on-the-ground view on the Indonesian economy. Mr. Bharat Joshi oversees investments in Jakarta, where he transferred in November 2014 after 7 years as an equity manager in the Kuala Lumpur office. His responsibilities there included research and management of local equity portfolios. Before joining Aberdeen, Bharat briefly worked as a junior analyst with Credit Suisse Malaysia. Bharat holds an honours degree in mathematics, statistics, and economics with a major in actuarial science from University of Warwick. Thank you, Bharat, for taking time to attend this interview with us. 6 months since the new Indonesian President Joko Widodo, also known as Jokowi, took office, Indonesia see a brighter fiscal prospect and business environment. The elimination of costly fuel subsidies provides additional fiscal space for Jokowi's administration to fund infrastructure projects that are expected to boost Indonesia's economic growth. Meanwhile, the newly launched one-stop integrated service will cut red tapes, simplify investment licensing procedures in Indonesia, in hope to reignite the interest of investors. However, the Indonesian economy also took a hit on low commodity prices and weak currencies. Despite Jokowi's pledge to boost Indonesian economy to a 7% growth, the central bank is looking at a range of about 5.4 to 5.8% this year. Against this background, could you share with us a brief outlook on the Indonesian economy?
I'll take that question in three parts. I'll give you the short term, the mid-term, and long term. In the short term, I think the outlook is actually very cautious. We have seen a lot of price pressures, especially with a lot of consumer companies, typically, and where they are seeing cost pressures, it's wages, rentals, and inflation. There was the tailwind from the weakening of the oil price that actually helped companies and especially consumers have more money in their pockets to consume, but sentiment is actually very weak in the short term. Not helped that the rupiah depreciated heavily over the US dollar. So people are more conservatory their capital in the short term. Mid-term, what's happening is the infrastructure will take off. Joko Widodo has made it very firm in his new reforms that he's putting across his infrastructure spending would happen. That would actually create a multiplier effect for employment, wages, and also consumer consumption spending. And banks will also continue to do very well. And then longer term, Aberdeen, we are very optimistic. Because if infrastructure spending takes off, then what you're going to see is productivity or improve, and also time to distribution will be a lot faster. So just to summarize that question, short term, a bit cautious. Mid-term, things will actually improve with the infrastructure spending, and hopefully in the long term, we might even achieve the 7% GDP growth as the president actually wants to expect of the country.
And what could be the key drivers for the Indonesian economy this year?
You will see the sectors do well this year would be the banks. The banks will continue, given the penetration in the market is still very low. It's only less banking penetration is only about 20%. So as income levels continue to rise and middle income demographics actually improve, you're going to see banks continue to do very well. Where you're going to also see people, especially when they're a bit cautious this year, they'll move into more defensive names. Telcos will do well, so telco operators, and also some selective consumer companies. And where I say selective consumer companies would be the likes of Unilever Indonesia, because they have very strong margins. Their distribution margins or distribution costs is still very, very insignificant to the grand scheme of things. As commodity prices continue to weaken, a few selective consumer companies will benefit. So Unilever will continue to do well, and banks especially. And recently, I would also echo the comment that the property sector will also do well, because banks are also now keen to lend, and interest rates have actually come off slightly, and people want to consume, or basically want to put their hard assets, to their money to work, and they will buy properties. So where the stocks that won't do well this year, or they've been very expensive, typically will be the commodity names. Commodity names have taken a beating for the last 2 to 3 years, unfortunately, and there's been no sight in terms of where coal prices are going to go or nickel prices are going to hit. And this is more of a slowing down of China. China used to be a big, a demand or importer of a lot of these commodities, and they have actually stopped consuming from Indonesia. Indonesia's exports are heavily dependent on commodities. So if commodities do recover, I suspect this year it won't recover. But if it does recover, it would actually improve the exports for Indonesia.
Any particular themes, strategies, or opportunities that investors can ride onto?
If you want to basically be, part of the Indonesia's swing in terms of opportunities, the banks especially will be a big sector investors will be keen to look at. And don't just focus on the big banks, because they're actually quite expensive. Try to look at the mid-sized banks where they have very strong balance sheets, and they have not been given the benefit given that they're mid-tier banks. So that would be one sector. I would also be a bit picky on some of the commodity names. Although they've been beaten down, valuations are actually very cheap. So and these companies typically move in cycles. So if you are basically getting it very cheap, sometimes even below book value, and some of them are actually net cash. So if you get in early, you buy them cheap, and the cycles recovers, you will basically be sitting on a multi-bagger. The other sector I'm also particular, or in Aberdeen we're quite particularly attracted to, is the cement industry, because infrastructure theme, it will happen. So it's a recurring theme that will be completed or be executed. The cement industry or the cement sector will be a prime beneficiary of that. So we do have two companies in our portfolio, which is Indo Cement. It's the second largest cement company, and we also have Holcim Indonesia. And the valuations for these two companies are still very attractive.
Political instability has always plagued the country, weighing on investor sentiment. Please share with us, what is the current landscape like in Indonesia?
I would have to, for us in Aberdeen, we have invested in Indonesia since the 80s actually. So we are accustomed, I would say, to the political climate in Indonesia. We have seen, riots on the streets, and still businesses continue to do well, excel. So when we invest in companies, especially in a very erratic climate like Indonesia, we focus just on the basics, which is businesses. There is obviously political interference, and it's common in most countries, especially in Southeast Asia. But you just got to be, don't get clouded or don't get trapped into the political noises, because a lot of these political noises are very populist in nature, and they all want to be voted in for the next election. So they will say whatever that needs to be said to the general public. But what gets done behind the scenes, it's basically they want to retain businesses. Because every company in Indonesia contributes to tax. And if they kill the businesses, or they become not investment savvy typically, or they don't favor the business operators, then they're going to be the brunt of that later. Because in Indonesia, tax income is very important. Given one of the biggest issues with Indonesia is because exportation has actually weakened dramatically. The government has to look at other tax revenues or other avenues to raise income level for government revenues, and tax is one of the key criteria that they're looking for. Indonesia, interesting enough, the tax inclusiveness is still very low. It's only about 12%. In Malaysia, it's about 16%. India is even higher than that. It's basically about 14 to 15%. So there's this 3% that's still undeclared income that can actually help tax collection. So that, in summary, it's for the tax revenues, but the political noises will continue. You will see a lot of bickering in politics, but you just ignore that. If you're an investor in Indonesia, it's not for the faint-hearted. You will definitely get really good returns 3 to 5 years, but you just got to be a bit patient in how you invest. Be a bit picky, and sometimes the political noises can be in your favor, because then valuations become quite attractive.
What are the other foreseeable risks in near term which investors should be cautious of?
I think one of the biggest risks in Indonesia, as you highlighted, is politics. And if the government interferes in businesses, can be quite negative to sentiment. That's number one. Number two is on the currency. The rupiah has weakened tremendously against the ringgit. It's the second or even the most depreciated currency in the region. But I think if you were to look at the currency aside and you just look at the fundamentals of the country, there are certain areas where there's been changes, dramatical changes, fundamentally. One is the government's debt ratios are very low. So the government hasn't really taken on in much debt in the last 5 years. The number two is household debt in the country is still very low. Banking penetration is only 20%. So even consumers are not heavily leveraged. Number three, the current account deficit, which for the first time was negative for the last 3 years, has started to improve. And so with oil prices now weakening, or has already been weak, Indonesia being a net importer of oil actually helps them. And the other issue is, in the past, Indonesia, given its subsidized oil, and given the geography of Indonesia, there was a lot of smuggling of oil into neighboring countries. And now with oil prices fully removed, completely removed, subsidy has been removed, importation of oil for smuggling has actually fallen. So there's a lot of savings that the government has put aside, and which a lot of investors has ignored. So in terms of the currency, I would say I'll be a bit skeptical if the currency even drops even further from now. So I think you will see this currency at about 13,000 to 13,500 stabilize, and perhaps if the president executes on the infrastructure spending, you will see improvement of the currency.
The Jakarta Composite Index has been on a long rally since 2009. Do you see a possible consolidation in near term?
Most of the consolidation has already happened. Some of the bits, especially this quarter and the tail end of last year. If you were to look at Indonesia, the stock market has hit all-time high, but the currency has hit pretty much depreciated. So if you're a foreign investor investing in Indonesia, I would say you haven't really made big money, until if the currency improves. Now there's still further room for the market to continue to rally because infrastructure haven't even been executed. So there's plenty of opportunities. And if the currency stabilizes or even appreciates, a foreign investor investing in Indonesia will get the upside from the local index and also the appreciation of the currency. So you get a double beneficiary. If in the past, if you were 3 years invested in Indonesia, you would have lost most of your gains in just currency depreciation.
In view of the currency risk, as you have mentioned earlier, will you recommend investors to hedge against the IDR in near term?
One of the things that I looked at in Indonesia, the IDR was depreciated twice, in the last 15 years. Was in the crisis, it touched a low of 16,000, and now it's at about 13,000. During the Asian crisis and where Indonesia is today is very different. And in 1997, Indonesia had a leveraged balance sheet. Most of Indo corporates had US dollar funding. Now, on the other hand, most of Indo corporates are actually local debt. They borrow locally. They don't borrow unless you have US dollar revenues. But if you have IDR local currency revenues, you typically borrow local currency debt. So the fundamentals have actually improved. And if you're a Singaporean investing in Indonesia, I would actually advise you to hedge maybe a little bit of your currency risk, because despite Indonesia has improving fundamentals against in Southeast Asia, but Sing dollar has always strengthened against all its Southeast Asian peers. If you're a Malaysian investor, it doesn't matter. But because Sing dollar has been one of the strongest currency in the region, then do hedge some of your risk in terms of your currency. Because over the last 15 years, it's only been Sing dollar against the IDR has only been one way. But for US dollar against Indonesian rupiah, you have seen the swings. So it depends on what currency you're looking at. Because hedging cost is actually quite expensive. And I would advise, don't hedge completely, hedge a little bit, because you will get the benefit when IDR actually starts appreciating. And when I say appreciate, it's not going to happen within 1 year. It would happen gradually, over the next 3 years.
Thank you, Bharat, for sharing your insights with us here today. For more information on unit trust, please log on to www.poems.com.sg/unit trust or talk to us at any Phillip Securities branches. Thank you.